recording with your colleagues.
Thank you.
Okay, so before we start, because this is our first session, I think there's some ground rules we need to lay down. So it's good to see that most of you have your microphones off. So if you're not speaking, kindly mute yourself. Class represents the entire class. I see only about 8 or so students.
We are a little above 20.
Little above 20.
Yes.
Okay. Okay, sure, we'll proceed. So the rest may join us later. Okay, so that's one. So if you're not speaking, kindly mute your mic. Number two, if you want to speak, kindly raise your hand. Okay, don't speak till I call you, because if you do, we may have some confusion, i.e. multiple people speaking at the same time. Okay, so if you want to speak, kindly raise your hand at an appropriate time. I will call you to either ask a question or to contribute to the discussions. Class discussions are rewarded, i.e. participation in class is rewarded. Okay, so when I say participation, I'm talking about asking questions and also answering questions that I pose or reacting to comments from your colleagues. Okay, so all these constitute class participation, and my assistant is going to record that. That will form part of your continuous assessment. Okay, so kindly take note that participation is rewarded and is graded. Okay, so asking questions, answering questions, making comments, and contributing to the discussion is very valuable, and consequently, I give some marks for that. Again, the attendance is recorded. Okay, so at the end of the session, my assistant will generate a Zoom attendance report, so we'll know who was in class and who wasn't in class. Okay, so also kindly take note of that. Now, finally, I require that you have your videos on. Okay, so you will see that I've turned on my video. So it's not compulsory, but I give marks for having your video on. Okay, so those who are in other classes, they'll tell you. I call it video marks. Okay, and if your video is on, I give you additional marks for the class participation. Okay, and when Kweku shares the marks for this week, you will see that those marks are included. Okay, so I'd highly recommend that you have your videos on. One, because it is rewarded, i.e. I give marks for that. If you don't have a video on, you're going to lose those marks. And those marks can make a difference between A and a B plus, or a pass and a fail. Okay, it happens always. And so I reward it for a number of reasons. I reward having your video on because, one, I'm able to see you. Okay, I can read your reactions, etc., whether you are following or not. Two, it forces you yourself to pay attention in class. Okay, so if your video is off, you can go off and do anything you want. Cooking, walking around, like you'll be very distracted. Okay, and that's a challenge with online classes. Okay, so to help you to stay focused, it's important that you have your video on. Okay, so those are the key things that I want to bring to your attention. Give me a moment. There's someone at my gate, so I'm turning off my video, but I'll come back on video. But we can talk for now. So ideally, for the interruption. So, like I was saying, kindly introduce yourselves when you are asking a question or answering a question, or you are reacting to what has been discussed or said in class. I think that would be more efficient. So what we're going to do today is risk and return. I spoke to Ben and he mentioned that he hadn't tackled this topic yet. So it looks like this is all we'll be able to do. We'll do this today and also next week. Okay, so I don't think I can finish the contents today, so we'll have to continue next week. So basically that's the plan for today and next week. We'll be doing risk and return. Okay, so any reactions? Do you have any questions? Anything you want to say before we start? Anybody? Okay, Bismarck, I see your hand is up.
Could we get slides?
Yeah, hello. I can hardly hear you. Bismarck, can you speak up or you should probably type. If you can't talk, kindly type. Okay, any other questions, comments, or reactions or remarks? Okay, I see that it appears that some people are in the group. Is it ELIKPLIMI? And okay, you would need to, if you are both in this class, you need to notify the assistant to record your attendance separately. Okay, other than that, you lose the attendance marks. Okay, so kindly notify Kweku. His name is Kweku Adomanko. He's in the chat, so you will see him. So kindly give him your details, your name and index number, so that he can record your attendance separately. Okay, Kweku, do you want to say something?
No, I was raising my hand so that they could see me.
Oh, okay, sure. Okay, yeah, so Kweku has raised his hand. He's making himself visible. Okay, so Bismarck. Is this slides you are worried about? Yeah, you get the slides. Contact your class rep. Okay, so I think we can get going. Okay, and today we'll be discussing risk and return. And basically, I mean, this is what excites people. Okay, when people invest in securities or asset classes, the exciting thing they talk about is return. Okay, but a lot of times the discussion doesn't progress beyond return to also talk about risk or to account for risk. Okay, but risk and return go together. Well, risk and return are like husband and wife, or they are like bedfellows. You can't talk about risk, or you can't talk about return without talking about risk. Okay. More often than not, people want to say, "Oh, and I made 80% returns. I made 90% returns. I made 200% returns." What was the risk that was taken to achieve those returns? Okay, that needs to also be factored into the discussion. And indeed, we know that risk drives return, or the key determinant of return is the risk. Okay, such that if you are going to invest in an instrument, so for example, men's gold, and they are offering 8% a month, you should flee for your life. Why should you flee for your life? Is it Emisa? Why should you flee for your life? Can you hear me? Let me say.
Yes, sir, we can.
Okay. So let me say, why should you flee for your life?
Say it's because it can't be trusted. Such a scheme cannot be trusted.
Okay, so high returns are an indication of high risk. Okay, so like I said previously, risk and return go together, such that if somebody is promising you very high returns, they're also promising you very high risk. So never forget that. If somebody is promising you very high returns, they're also promising you very high risk. Okay, so for example, I mentioned a man's good example where they are given 8%. Where they are given 8% a month. Okay, what's 8 times 12? You've forgotten your multiplication table, right? It's 96.
96.
Okay, so 8 times 12 is 96. So this is a nominal return. Okay, I'm sure that Ben has also done effective returns with you. So how do you find the effective return? You go to formulas, financial in Excel, and then you look for where's effect. Okay, so effect. So the nominal rate is 0.96. You have how many compounding periods? 12 compounding periods. And consequently, what do you think is your effective return? What's your effective return? The answer is there. Who can tell me?
1.518.
But you see, you need to change it to a percentage. I did 0.96, which is 96%. Okay, so this 152%. If you change this into percentage, this 152%, then we round up. So percent. Okay, that's 152%. That's crazy. How is a person going to make profit of so much and pay you 150%? They have to pay their expenses, pay their salaries, pay operational cost, pay taxes. Okay. And then, so how much do they have to make to be able to pay you 150%? Obviously, this scheme will collapse. You don't need to be a prophet to be able to tell, sorry, that a scheme like this will collapse. Okay, you don't need to be a prophet at all. Okay, is there Sadiq?
So yeah, Sadiq. My name is Sadiq. Good afternoon.
Yeah.
You are saying that if like the 96% where you get 152 back, it's risky. But I know of do I say a scheme or a company that is giving out 40% of your money back at the end of 30 days, and there's one that gives 80% money back, but that one is above 20K at the end of after 30 days back, and people are cashing out.
Well, I don't know the details. I would advise you to be extremely cautious.
Okay.
That would be my advice to you. There's nothing like a money machine in finance. Printing dollar notes. No, there's nothing like that. Some people may cash out, but some people will lose. Okay, it's a Ponzi scheme. At a point in time, the scheme will collapse. Ponzi schemes can last sometimes for 20 years, 30 years. But one day, the house of cards will come collapsing. Okay, so I would really advise you to stay away from schemes like that. If you are not sure, okay, one, you can contact SEC to make an inquiry. Check that the scheme is licensed. These are some ways to keep yourself safe. So check that the scheme is licensed by maybe Bank of Ghana, SEC, MPRA, or NIC. You need to check if it has a license from any of the regulators. That's number one. Number two, even if it has a license and you're not comfortable, lodge, call SEC or send an inquiry to find out that these are the terms of the investment. You are not very comfortable. They will tell you whether it's a good investment or not. They will investigate. Okay, so my friend, if it sounds too good to be true, it probably is too good to be true. Okay, so don't waste your time on unless you want to gamble. If you have money to gamble, fine. If you have money to lose, you may win some, you may lose some. If you want to play a lottery, fine. Okay, but I won't advise you to do that. So even men's gold, okay, as far back as 2014, 2015, one of my students came to see me. Oh, this good investment. I told you, no, the returns you are talking about is not possible. I said, no, they are doing what? Derivatives, blah blah blah. So what kind of derivatives? You see, if you understand finance, you will know that it's a scam because they are trading gold, or they say they are trading gold. If your finance is really good, you will know that the returns on gold are not very high. I don't need to tell you. You can go online and go and check. Okay, I didn't know it would be. It's just by the way, but you can go online. You can go to, there are places like CNBC, Yahoo Finance, the very useful resources that you can check some of these things. Okay, so you can go to CNBC. It's a very good resource. It's on the internet. You can go to Yahoo Finance. You see gold prices, okay, oil prices, etc. So let's do Yahoo Finance. And like I was saying, gold has a very low beta, or sometimes even its beta can be negative. Okay, meaning that, just a moment. Okay, meaning that gold in portfolio construction is like, I call it a shock absorber. Okay, if you are constructing your portfolio, the role of gold is like that of a shock absorber, i.e., when investments are not doing very well, or when the stock market goes down, or when we have a recession, that is when gold performs very well. Okay, because there's something called flight to quality. When there's fear in financial markets, people are afraid, they don't know what to buy, and they are fleeing the stock market. They run to things that they feel are safe. Okay, like the US dollar, like the yen, and gold. So in normal times, gold doesn't provide very high returns. Okay, in normal times, gold doesn't provide very high returns. Okay, in reality, sometimes in normal times, the return on gold can be negative, i.e., how do I explain it to you? Gold doesn't pay you; you pay to hold gold. Okay, gold doesn't pay you; you pay to hold gold because the returns are negative. Okay, but investors are happy to hold gold as part of their portfolio because they know that in times of crisis, gold prices do very well. Okay, in time, so I'll show you very quickly. If you look at what happened to gold prices in 2020 when COVID-19 hit. Okay, let me give you maximum full screen. Okay, if you look at gold prices during COVID-19, you will see I wish I could expand this a bit more. Okay, 5 maximum. Let me do it maximum. Now look at something. Do you see what happened in 2007? It was a huge spike. What was that? You can tell me. 2007, 2008, 2009, global financial crisis. Okay, 2010, European debt crisis. So you will see the increase in the price of gold. Then it goes down, and again, you observe something similar from 2020. Okay, you observe something similar from 2020, and this is the COVID-19. Again, a huge spike in gold prices. Okay, so when somebody is trading gold and they're giving you 152% a year, I don't need to be a prophet to tell you that such a scheme is not sustainable. It will collapse. Okay, any questions before we go ahead? Michael. Okay, so Michael, what we are saying is that gold prices, okay, don't do very well in normal times, but during a recession, they perform well. Of course, if you can get gold for nothing in the ground, okay, and then you can sell it for, at a point in time, prices of gold went to more than $2,000. Okay, if you look at it here, this was $2,010. This was November. This was around November. Let me check the exact date for you. Okay, so July, around August 2020. Okay, gold prices went above $2,000. Okay, so if you can get gold in the ground for nothing, okay, and sell it for $2,000, of course, you will do it, okay. And these guys, what do they need? Galamsey doesn't involve much. On the basic Galamsey, all they need is a whole, maybe a pan and labor, okay. So for them, it can still be worth it because you are getting the gold for basically nothing, okay, and you can sell it in the financial markets for a high price, or you can sell it in the market for a high price. I hope that clarifies your question. Okay, so yes, if you are mining gold, that is different. Okay, if you are mining gold and you can get a gold at a cost below the market price in the global financial markets, that still makes sense. But what we're talking about is buying gold as an investment. Okay, what I'm talking about is buying gold as an investment. It may sound strange to you in Ghana, but you can actually buy commodities. Okay, so let me show you. Give me a moment, I'll show you very soon. You can trade oil, natural gas, cocoa, pork bellies, blah, blah, blah. Give me a moment. Hey, can you still see my screen? No. You shouldn't be seeing my screen. Okay, so I'll be with you in a moment. Can you see my screen now? I guess not. Are you able to see my screen? I'm trying to share again.
No, please.
No, sir.
Oh, okay.
No, we can't see it.
Okay. Okay, so all right. Okay, so you can buy, like I was saying, you can, so was it Michael who asked the question? You can buy gold. Okay, so let me show you. But some of these options are not available in Ghana now. So commodities. Yeah, so physical, you can buy silver, palladium, platinum, crude oil, gold. There's another gold bullion. Okay, so what I'm saying is when you're buying gold to hold as a financial asset, or you're holding gold in reserves. So for example, the Bank of Ghana holds, or central banks hold gold in reserve. The return on gold is not very high. The return on gold. So there's gold as, this one is, if you read it, summary, the gold is held in, okay, some are held in bullions in the UK, etc. Okay, so basically that's the point that I'm making, that gold doesn't offer high returns, and therefore it's only promising you 150% on gold. It doesn't make sense at all. Okay, so basically that's what I wanted you to know. Okay, so to summarize, risk and return go together. If somebody is promising you high returns, they're also promising you high risk. And they're also promising you high risk. Okay. Now, I'm looking at the time and I'm laughing because we haven't done anything. But there's a lot to cover. So we'll get there. Let's see what we're able to do. Okay, so basically what I'm showing you now is stock market history or returns for the stock market in the US. Okay, starting from 1928. I think this one even goes beyond 19. Yeah, okay, 1928. So starting from 1928. So was any of you alive in 1928? Maybe you've gone and come reincarnation. Anyways, so let's assume that. So this obviously, let's say your grandfather, okay, was alive in 1928, and he happened to go to the US, and on his trip to the US, he invested. I'm going to change the example slightly. Here they use $100, but I'm going to make $1,000. Okay, so your grandfather invested $1,000 in the US stock market. Now, let me show you the value as at end of 2020. Okay, as at end of 2020, that $1,000 was worth almost $6 million. Okay, so there's a one-time or single deposit of $1,000 in the US stock market in 1928. Of course, 1928 is a long time period. So when I tell people, oh, you can invest in stocks, I say, but I'll be dead. Yeah, but you may be dead, but you may have survivors or people you want to bequeath your wealth to. And $1,000 is not too much to invest. Okay, if your grandfather had done $1,000, today you'll be a millionaire. If you had done $10,000, that would be $60 million. a one-time deposit of $10,000. That would be $60 million. Okay, but obviously this is almost 100 years. I guess 2028 to be 100 years. Okay, so this is almost 100 years of returns, but 100 years is not too long. Okay, some people are actually 100 years old, so it's not impossible. Okay, so these are the kind of returns that you can get from investing in stocks. But I should warn you that these are long-term returns. Okay, these are long-term returns. If you look at the stock market history, you will notice various years where investors lost money. So look at 1930, minus 25%. 1931, minus 43%. If you know history well, this is what they call the Great Repression, the Great Depression, okay, occurred in the US in the 1930s. If you count in the 1970s, again here, there's an oil price crisis, okay, in the 1970s. So that's oil price crisis. And then you come, where again, around 1999, there was another, so 2000 here. This is what they call the dot-com bust. Okay, 2000, 201, 202, dot-com bust. Okay, so that's these returns. Then when you come to 2008, we know what happened. That's a global financial crisis. Is that okay? So across history, there have been years when investors have lost money, sometimes almost 50%. You can see that here in a year. Okay, but over the long term, investors still are able to make a decent return. Okay, over the long term, investors are still able to make a decent return. So that's for stocks. Let's look at Treasury bills. So instead of doing US stocks, sorry, let's assume that your grandfather did USD bills. Okay, and they invested $1,000 in Treasury bills. At the end of 2020, that money was $20,000. So remember that instead of 100, I'm making 1,000. So you add 10. Okay. So if your grandfather was risk averse, me, I don't like the volatility in stock markets. So let me put the money into Treasury bills. Okay, that $1,000 today is $20,000. What about if you had done Treasury bonds? So instead of Treasury bills, let's look for Treasury bonds. So here we go. We have UST bonds. Okay, that was worth 8,920. So if we add 10, that will be how much? That'll be $89,000. Okay. So Treasury bonds would have been $89,000. And then let's do corporate bonds. So again, you know that corporate bonds are riskier than Treasury instruments. So if your grandfather had done corporate bonds, that would be $530,000. So actually, just about 10% of the amount of stocks. It's actually less than 10%. Okay, so that's asset class returns from the US, and this record repeats across different countries in the world. Okay, so it's not just restricted to the US; it applies to different countries in the world, even including Ghana. Okay, I had one of my students some time back do her long essay on something like this. And again, in Ghana, stocks outperformed Treasury bills. Okay, so basically, that's some asset price history. And in terms of risk and return, we see clearly some trends. So number one, lowest risk is T-bills. Then you go to next Treasury notes, then Treasury bonds, then corporate bonds, then publicly listed companies. Then you have private companies, okay, companies that are invested in by private equity funds or venture capital funds. And then you also have hedge funds. I'm sure that these have been mentioned to you by Ben. Okay, so there's some pattern, there's some trend, and there's a correlation between risk and return. The higher the risk, the higher the expected return. So it's not the higher the risk, the higher the return. It's the higher the risk, the higher the expected return. Okay, so I hear people saying the higher the risk, the higher the return. That's not entirely correct. It's the higher the risk, the higher the expected return. If you don't believe me, go and ask the investors in Men's Gold whether they got the expected return. Okay, so higher risk correlates with higher return in expectation, not always. Okay, but on the average, the higher the risk, the higher the expected return. Okay, on the average, the higher the risk, the higher the expected return. Okay, so there are two main types of risks and returns. We will talk about realized returns or historical returns, and we'll talk about expected returns and expected risk. Okay, so the first one, we're looking at historical returns and historical risk. And in the second case, we're looking at future returns or future risk, where we don't know the returns with certainty and where the returns are associated with probabilities. Okay, that is why it's called expected returns, because we don't know those returns with certainty. Those returns are associated with uncertainty or probabilities. Okay, so that is why we call them expected returns. Okay, so how do we find returns? So basically, your return is broken down into the dividend yield and the capital gains yield. So again, I'm sure this is something that you may have come across already. So if you buy, let's say, a stock, okay, the return is equal to the dividends you receive plus the price you can sell it for minus the purchase price over the purchase price. Okay, and this can further be broken down into the dividend yield and the capital gains yield. Now, let's talk about arithmetic returns and geometric returns. So this is how you find your arithmetic returns when you have prices. Okay, so it's PT minus 1 over PT minus 1. So similar to what we talked about earlier. And your geometric return is length of PT over PT minus 1. Okay, so that's how to find your geometric returns. I'm wondering if it's worth demonstrating. Just a moment. So it's actually very easy. So let me see. Maybe I should give you. I should give you an example. So we are going to construct this example on the go, on the fly. So let's see. So let me just do something quickly so that you can appreciate what I'm saying. So we need to change this. Let's say yeah, stock price time 1, time 2, maybe time 3. Stock price is 15, 55. I think this should be enough. Okay, so what I'm saying is that okay, the arithmetic return is simply your new minus old, new minus old, new minus old over old. Okay, that's 10%. Then the geometric return is length of this over that, which is usually a below the arithmetic returns. Okay, so basically that's what I'm saying. Okay, so this one is just a simple percentage change, and this is a length with the new price over the old price. Is it a bit clearer? Okay, so basically this is an example. Okay, so that's what I was trying to explain. So here we have prices, and we use these formulas to find the arithmetic return and the geometric return. Okay, so basically that's what we just did. Okay, so here we can incorporate dividends. So we include the dividends here, and also we add dividends here. Okay, so it's the same formula, but now we are including dividends. Okay, so here we add dividends, here we add dividends as well. Okay, so basically, that's your RE return and your GEO return. Now, let's stay on this a bit more. Now, if we have a series of return, we can find the arithmetic return. Basically, the arithmetic return is the sum of the returns divided by the number of years or the number of observations. Okay, is the sum of the returns divided by the number of years or the number of observations. Okay, so that's your arithmetic for your simple average return. So here we are working with returns, not prices. Okay, initially we were working with prices. Now we are working with returns. Okay, so that's our arithmetic return. And here we find our geometric return. And the geometric return is simply 1 plus your, I'll explain this shortly. So 1 plus your return. And this is called here. 1 plus HPR is called the return relative. Okay. So 1 plus the HPR is called the return relative. This pi here is not 3.14. It's just to indicate that we multiply. So we multiply 1 plus the returns, we raise to the power 1 over n, and then subtract 1. So we'll look at an example to make this easy to follow. So let's look at our example. Here we have returns for 5 years. We want to find the arithmetic return and the geometric return. Okay, so if you remember, I said arithmetic return, we sum the returns and divide by the number of observations. So let's sum the returns together. What's 10 plus 30?
40.
Okay. What's 40 minus 20?
20.
What's 20 plus 0?
20.
What's 20 plus 20?
40. 40.
Okay, so 40 over how many years do we have?
9. 5.
5. So that gives us our arithmetic return to
8. Okay.
So very simple, sum the returns and divide by n. Okay, that gives you your arithmetic. Let's look at the geometric return. So for the GEO return, like I said earlier, 1 plus your holding period return. So 1 plus 0.1 is 1.1. Okay. What's 1 plus 0.3?
1.30.
1 plus.
0.3.
It's 1 plus 1. 1.1.
No, 1 plus 0.3.
1.3.
1.3.
Yeah.
So year 1 is 1 plus 0.1. Okay, which is 1.1. Year 2 is 1 plus 0.3, which is 1.3. Okay, what's year 3? What's 1 plus minus 0.2?
0.8.
0.8.
0.8. So that shows you that there was a fall or a decline. Can you see that? Because 1 is like 100%. So if you have 0.8,
Yes.
that was a decline. Okay, so that's 0.8. What's 1 plus 0?
1.
1 plus 0 is 1, right? And then what is 1 plus 0.2?
1.2.
1.2. So what do we do next? Remember, arithmetic, we sum. Geometric, we don't sum. What do we do?
We multiply.
We
We
multiply.
multiply.
Okay. So doing 1.1 times 1.3 times 0.8 times 1 times 1.2. And tell me what you get.
When you multiply, it's 1.3728.
Okay. That 1.3728 is called the cumulative wealth index. Okay. So it's a shortcut. I can why then was yes and open. Okay, so I can explain it now. The value that we are calling the cumulative wealth index is the product of the return relatives. Okay, so that 1.3728 you have is called the cumulative wealth index.
Okay.
So if I want to know how much 10,000, if I invested $10,000, how much it will go to, I multiply by that figure. Okay, so do that and let's see. Or you like 1,000, multiply 1,000 by the figure you have.
1,372.
Okay, it will be 1,372.8. And that's what I have, what do you call it? Rounded off here to get 1,373. Okay, so when you multiply, that thing you get is called the cumulative wealth index. But that's not the end if you want to find the geometric return. What do? We raise it upon 1 over n, right? So we multiply the cumulative, we raise it to the power 1 over n, and then we subtract 1. So do that and tell me what you get. So we multiply the return relatives, okay? And then we raise the final answer or the cumulative to 1 over n. Again, remember that n is 5, and then we subtract 1. And that will give you 6.54%. Do we all have that? So I can give you a few minutes to do that. So 1.1 times 1.3 times 0.8 times 1 times 1.2 is upon 1 over 5 minus 1. That should give you 6.54%.
6.5.
Okay, so that's your geometric return. And that's your geometric return. And again, remember that I said the product before you raise to the power 1 over n is called the cumulative wealth index. So I could ask you a question that find the value of $10,000 at the end of 5 years. You simply multiply $10,000 by the 1.3. What did you get? 1.3 what? 3728. Okay, 1.3728. Multiply it by 10,000. And that will give you the value of the investment at the end of the 5 years. And indeed, we can show that this is true. Okay, so again, start with me. So multiply 1,000 by 1.1, which is our 10%. Okay, so what's 1,000 times? I feel like we can come back here. What's 1,000 times 1.1?
1,100.
1,100, right? So that's what you have. Then multiply 1,100 by 1.3. What do you get?
430.
1.30. Then multiply that by 0.8. So times 0.8. You get 1144, right?
1144. Yes.
Then multiply that by 1. Again, you get 1144. And then multiply that by 1.2. That gives you 1372.80.
Now why by 1 instead of 0?
Okay, so good question. The answer is, if you remember here, okay, 1 plus 0.
Okay. Thank you.
1 plus 0. So that's how we multiply by 1. If you multiply by 0, everything will go to 0. Okay, so 1 times 1 plus 0. Okay, so that's the reason. Okay, so as you can see, we have 172, maybe I should have 172.80 here. Okay, so that's the ending value of the investment. If we didn't know the geometric return, we could find the ending value of the investment by saying we started with 1,000 cedis or $1,000. We earn 10%, so we increase it by 10%, increase it by 30%, reduce it by 20%. Here, 0% is like no change. Okay, so that's why I multiply by 1, and then we increase it by 20%, and this is what we get: 1372.80 as the ending value. Now, of course, we already know that when we use a geometric return, okay, the answer will be 1372.80. We know that already, right? Because if you multiply the cumulative wealth index by $1,000, that's what you get. Do you remember? If you multiply the cumulative wealth index by $1,000, that's what you get. But we can find the different ways to skin a cat or kill a cat. Okay, so we can get back to this number using an alternative approach. So let's use the future value approach. And we know that the future value is equal to what? Present value times 1 plus r raised to the power n. I hope you remember. Okay, so future value is equal to present value times 1 plus r raised to the power n. Remember that our geometric return is like an average return over the 5 years. Okay, it's like, if you look at the returns carefully, you will see that we didn't earn 6.54% in any year. Okay, actually, if you look at the returns carefully, we had 10%, 30%, minus 20, 0, 20. But we are saying that the 6.5% is like the average return over the 5 years in terms of the geometric return. Okay, so we can use that return. Okay, so we can use that return and raise to the power. So 1 plus r raised to the power 5. And again, we get this answer, 1372.80. Okay, so you can try it yourself and see. Let me give you a few minutes to do that. So 1.0654, this is the power 5, and multiply by 1,000. And you get almost the same answer. Yes, Bismarck.
So please, mine is to do with the approximation. Because if you leave the approximation in the 4 decimal place, you don't get the same answer.
Yeah, I wouldn't worry about that. Okay, you know the reason is approximation. So we are not using a full amount. Okay, so that's where the running error comes from. So I wouldn't bother about that. On my calculator, I had 1372.66. Okay, but that's just approximation errors. So I wouldn't worry about that. If it's an exam, nobody will penalize you. Okay, so yeah,
Thank you.
You get the same thing at the end of 5 years. What about if we use the arithmetic return? If you remember, the arithmetic return was how much? Do you remember? What was our arithmetic return? 8%. Okay, so let's try again the same procedure, but now we are going to use the arithmetic return. So that is, again, future value is equal to present value, which is 1,000 times 1 plus R. Here, the average return is 8%. For how many years? 5 years. And tell me what you get.
1,469.32.
Okay, so again, we have 1,469. And that raises some interesting observations. Who can tell me what do you observe? What do you observe? Best mark.
So the arithmetic is higher than the geometric. So
Okay, so that's a good one. Number one, the arithmetic return is usually higher than the geometric return. But more importantly, what was the ending value of the investment when we increased it by the rates we know? 1372280. Okay, so this was the actual ending value of the investment. Now, when we compare the arithmetic return and the geometric return, which one gives us the correct ending value? It's a geometric return. Can you see that? Arithmetic return has overestimated the ending value. Okay, so the geometric return is also called a compounded rate of return, and that is the return that gives you the ending value of the investment. Okay, so your geometric return is again your compounded rate of return, and that is the return that gives you the ending value of the investment. So again, I didn't explain this earlier, but you should understand it now. Okay, so the geometric mean return is the one return that, if earned in each of the n years of an investment's life, gives the same total dollar result as the actual investment. Okay, so the geometric return gives you that. It gives you the ending value of the investment. The arithmetic return does not. Okay, so again, I didn't explain this, but it should make sense now. So oddly enough, earning the arithmetic return for n years is not generally equivalent to the actual amount of money earned by the investment over all n time periods. So I think that should make sense now. Okay, so it's only the compounded rate of return on the geometric return that gives you the ending value of the investment. Okay, it's only the geometric return that gives you the ending value of the investment. And like Bismarck rightly said, typically the geometric return is lower than the arithmetic return, or conversely, the arithmetic return is higher than the geometric return. Okay, we'll look at why very soon. Should I do why now or later? Okay, let's look at why. So it's mainly because of the volatilities in the rates of return. Okay, so usually if you have higher volatility, okay, then the geometric return will be way less than the arithmetic return. Okay, so if returns are very stable, then the geometric returns and arithmetic returns are very similar, more or less. That's what I'm saying. But if returns are not very stable, or if there's a wide variation in returns, then there's a bigger difference between the geometric return and the arithmetic return. In particular, the geometric return is approximated as your arithmetic return minus half your variance. Okay, so again, in an exam question, I could ask you, I only give you your arithmetic return, give you variance, and ask you to find the geometric return. You should be able to do this. Okay? Because the geometric return is equal to the RE return minus half the variance. Okay, so the larger the difference, or the larger the standard deviation, or the larger the volatilities in financial markets, the bigger the difference between the arithmetic return and the geometric return. Okay, so this is the formula to to get the approximation. So let's do the approximation very quickly. We know our geometric return to be equal to, what's our RE return? Do you remember? It was 8%, right? So 8% minus half the variance. We haven't found the variance yet, but I'm going to give it to you. So we're going to assume that we know it. Okay. So we're going to assume we know it. Okay. So this is your variance. We'll do it later, today or tomorrow. Not tomorrow, actually, maybe next week. So depending on what we're able to do today, we'll come back to this value. But now assume we know the variance. So I'm giving you the variance. So it's our arithmetic return, which is 8% minus half of the variance. And that gives you 6.16%. Do you remember the actual geometric return? It was 6.54%. Okay, so this is just an approximation formula. Okay, this is just an approximation formula. Helps you to approximate the geometric return, given that we know the arithmetic return and the variance. Okay, so usually, like Bismarck rightly said, the arithmetic return will be lower than, sorry, the geometric return will be lower than the arithmetic return. Or conversely, the arithmetic return will be higher than what? The geometric return. Okay, the arithmetic return will be higher than the geometric return. Let's look at one last way to skin this cat. So remember, we found the geometric return to be 6.54%. Is there another way to find it? There is. Okay, so yeah, you can find it this way. So RT is equal to ln. Remember, we saw this earlier. Ln PT over PT minus 1. Okay, do you remember this? We saw this earlier. Okay, so let's do ln. Here, what is our PT? Our PT will be the value in year 5, or i.e. the ending value of the investment. Okay, so we have 1327.8. So that's where this number is coming from. That's the ending value of the investment over the initial investment, so over 1,000. When you take the ln, what do you get? 0.3169, I guess.
So 0.1.
Are you sure? Do it again. So 1372.8 over 1,000, and then take the ln.
0.3168.
Okay.
0.3168.
6185, which is 0.36.
Okay, so yeah, so 0.3169. Okay, then we divide this by 5 because remember, this one is a 5-year interval. It's not yearly intervals. Okay, so we divide by 5, and then we get 0.0634. And then you raise it, so you have e raised to the power 0.0634 minus 1. Maybe I should show you how to do this on. So where's my calculator? Okay, so you have so 1372.8. We divide that by 1,000, and then we get this. Then we take the ln. Okay, then we get this 0. Let me go back. Okay, so then we get this. Then we divide this by 5. So divided by 5. We get this, and then we do e raised to the power. So this is your e. So it's on top of the length. Okay, so e raised to the power this minus 1. Again, we get 6.54%. So different ways to skin a cat or to kill a cat. But at the end of the day, the cat should be dead, right? We want the cat dead. So there's another way to find your geometric return. Once the cat is dead, we don't mind. You get your max, or you get credit for solving a problem. Okay, so 6.5%, 6.54%. Again, this is your geometric return. So different ways to skin the cat, but the cat is dead. Okay, so here our geometric return again is 6.54%. Which one is better? Arithmetic returns or geometric returns? Well, generally, let me say it depends on your interest. Okay, the simple average return is your arithmetic return. If you want a compounded rate of return, then you need the geometric return. Okay, so it depends. So again, let me say that again. Your simple average return is an arithmetic return. If you want a compounded return, that takes into account reinvestment. Okay, then you are interested in the geometric return. Arithmetic return doesn't account for reinvestment. Geometric return does. You remember your high school simple interest, compound interest? Do you remember? Okay, so compound, your geo return is your compound return. Arithmetic return is like simple return. It doesn't account for reinvestment. But your geometric return accounts for compounding or reinvestment. Yeah, so it does depend on what you're interested in. But usually the geometric return has some nice properties, especially in finance. Okay, so one, it doesn't lead to negative prices. Can an asset price be negative? Or can the value of a company be negative?
Yes, sir.
Okay, let's not say company, let's say a price, stock price. Can stock price be negative? I haven't seen some before.
I haven't seen them before.
Like I haven't gone to the stock market and see a negative stock price. That'll be phenomenal. Okay, so the geometric return has nice properties. Okay, i.e., we say that returns are normally distributed. Okay, but stock prices have a log-normal distribution, and that's arising from what we said earlier, that geometric returns don't lead to negative stock prices. Okay, so stock prices have what we call a log-normal distribution. Do you know how the log-normal distribution looks like? Guys, have you seen the log-normal distribution before?
No, please.
No, sir.
Are you sure? I'm sure you've seen it. Maybe you just don't remember. Okay, so log-normal. But you've seen normal distribution before.
Yes, please.
Just a moment. Yes. Share again. So this is your log normal distribution. Okay. And it doesn't go into negatives. So stock prices we say are log normally distributed, and you have returns being normally distributed. Okay, I guess you know your normal distribution. This is a normal distribution. Okay, so returns can be negative, but prices cannot be negative. Okay, so stock prices exhibit normal distributions, and returns exhibit normal distributions. Okay, so that's one nice property of the geometric return. If you remember, we took logs, okay, to get the geometric return. Then again, another property is that I don't know how to explain this. Not all of you may have. So when you quote currencies, CD per dollar or dollar per CD, okay, depending on how you quote, it has implications. I won't go into too much detail. We have what we call direct quote, indirect quote, blah, blah, blah. But whether it's a direct quote or indirect quote, you can work with the geometric return, not arithmetic. Arithmetic depends on how you quote it. Okay, geometric return, you can work either ways. Okay, so that's another nice property of the geometric return. And finally, if we are dealing with multiple periods, the geometric return over the period is a sum of the one period geometric returns. Okay, so when you look at multiple periods, the geo return, you can sum them. Okay, you can sum the geo returns across time. Basically, that's the last point. So yes, what I'm saying is that point number one, it depends on what you're interested in. Are you interested in the simple return, which doesn't include compounding, in which case you should use the arithmetic return? Or are you interested in the compounded return, in which case you should use what? The geometric return. In addition, what I'm saying is that the geo return has very nice properties that we like, and therefore it's used a lot in finance. Okay, these are some of the properties that make the geometric return very, very well attractive. These are some of the properties that make the geometric return attractive. Okay, let's take a short break. So let's stretch. So you can take a 5-minute break. Okay, we'll come back in 5 minutes and then we'll wrap up for today. Okay, so we can take a quick break and then reconvene from the short break. I hope you're able to stretch, get some water, etc. So we can wrap up now. So we've looked at arithmetic return and geometric returns, the differences between the two, when it's appropriate to use which, and the nice properties of the geometric return. Okay, let's now look at what we call multi-period return, which is a bit more complicated. Okay, so when we talk about multi-period return, for example, let's say a fund that has inflows and outflows, people buying at different time periods, people selling at different time periods. How do you compute the return of such a fund? Or again, imagine that you buy a particular stock. You buy some initially, then you top up, then you sell, then you receive dividends. How do you compute the return on the stock in such a scenario? And so basically, we're going to use the concept of the internal rate of return. I'm sure that Ben has done this with you because he mentioned that he had done capital budgeting. And so we're going to use the concept of the internal rate of return to solve for this return. Okay, so basically what we do is now we set it up as a discounted cash flow problem. Okay, so let's say that we invested $50 in a stock. So that's on your left side, on your left-hand side. We invested $50. At the end of the first year, we got $2 and we sold the stock for how much? $53. Now, how do you find the return? So we look for the rate R. That gives us the price of $50. Okay, and again, remember that I said that rate is the internal rate of return. And if you solve for R, you'll notice that R is equal to 10%. But this is 55 over 1 plus R is equal to 50. Then you can multiply it, you get 50 times 1 plus R is equal to 55. You do 55 over 50, and then you subtract 1, and you get 10%. So that's something that you should be able to do. Can you solve this on your own? 50 is equal to 55 over 1 plus R. Just solve for R. Okay, and you'll find R to be 10%. So yeah, we usually start with the simple ones. Let's look at a bit more complicated example. So the same example, we bought a stock for $50 at year 0 or time 0. Then at time 1, we bought an additional stock for $53. Okay, so these are the outflows, left-hand side. Then at time 1, we got a dividend of $2 on the first stock. At time 2, again, we got a dividend of $2 per stock. But remember that in time 2, we own how many shares? How many shares do we own?
52.
2 shares. Okay. So we'll get $4 in terms of dividends, $2 per share, or 2 times 2 gives you $4. Okay, so these are the cash flows. Year 0, we invested $50, plus year 1, we invested 53. Why do we need to discount? Because we are finding the present value. Okay. So we need to discount this. It's equal to, and then these are the inflows. Year 1, we got $2 as a dividend. Again, we discount for 1 year with R. And year 2, this 112, where is it coming from? Who can tell me? Where is the 112 coming from? You guys, do you remember? It's $4 total dividends in year 2. And then we sold the stock for $54 per share. How many shares do we have? 2 shares. So what's 54 times 2?
108.
It will be 108. Okay, so 108 plus 4 is 112. So that's where that figure is coming from. Okay, so we sold the 2 shares at the end of year 2 for 108, and in year 2 we received dividends of 4. So total inflow in year 2 is 112. So that's this 112, 1 plus R for 2 years, because it occurs in year 2. So again, I presume you understand this because you've done capital budgeting. Okay, you've done time value of money as well. So you should understand this. So we saw for R, if you plug in R of 7.117%, you get a PV of the stock. Okay, i.e., this 7.117% is the internal rate of return. Okay, if you remember the concept of the internal rate of return, is the rate that gives you an NPV of what? 0. i.e., is the rate that equates the inflows to the outflows. And that is what we are doing here. Okay? Is the rate that equates the inflows, right-hand side, to the outflows, left-hand side. If left-hand side is equal to right-hand side, the difference will be equal to what?
Break-even.
If left-hand side is equal to right-hand side, the difference will be equal to what? 0.
Break-even.
Okay, so that's the internal rate of return, IRR. So I can do this in Excel with you. So set it up. So open an Excel sheet And let's do it together. Set up the problem. Give me a moment, let me plug my charger. So. If you have an Excel sheet, it's good to follow. Makes your life easy, simple. So year 0, we bought the stock for how much? $50. Okay, so that's this 50. Year 1, we got a dividend of $2. Okay, so that's 2 here, and we bought an additional share for $53. So the net cash flow in year 1 is minus 51. Then in year 2, we sold the 2 shares for 108, so 54 times 2, and received $2 dividends on each stock. So that's just 112. And then you come here. Here you want to find the internal rate of return. So you go to formulas, you go to financial, you look for IRR. Where's IRR? Okay, you look for IRR. And then it says you should select values. So we choose these values and we press OK or done. And we get 7.117%. So that's your internal rate of return. And remember, okay, let me pause a bit. Let me give you time to do this on your own. Okay, so just enter the cash flows. Year 0, year 1, year 2. These are your cash flows. Enter them. And then you can come and find the internal rate of return. So you go to formulas, financial, choose IRR, and the values are the cash flows. So choose the cash flows, press OK or done, and you have your internal rate of return. Are we together? Okay, so who has been able to do it? If you've been able to do it, just type yes in the chat. Let me get a sense of how many of you. Okay, so Besma. Okay, Emmanuel is on it. Yeah, Besma, your hand is up.
Yeah. No, please, mine, I got exactly 7%.
Increase the decimal places. You can increase the decimal places here.
Okay, sir.
I believe that would give you. So try it. This is reduce decimal. Yeah. Did it work?
Yes, sir, it worked.
Oh,
So I got 7.117.
Okay, excellent. So just you can just increase decimal places, reduce decimal places. Yeah. So 7.1111%. Okay, so basically that's who else has been able to do it now? Sadiq is also on it. So it's very simple. You just need to enter the cash flows year 1, year 0, year 1, year 2, and then you just go here, formulas, okay, financial, IRR, which is the internal rate of return. Nice. Internal rate of return. It asks you to select the values of the cash flows. Just select your cash flows and press OK or done. And that'll give you your answer. Easy peasy. So how many have been able to do it now? Listen, have you done it? Martin. Were you able to do it?
Not yet, please.
Okay, Theophilus, well done. Michael Asamoah. Okay, Michael says done. Ifwa Amanin. Ifwa, are you there?
Yes, please, I'm here.
This one I check
On
whether
it,
you are in
please.
class. Okay, what did you say? Ifwa, what did you say?
Please, I'm here. I'm saying that I'm on it.
You're on it. Okay. So there's a roll call. Dennis, if you don't answer, you don't get your attendance marks. Dennis, Amu,
Yeah, I'm here.
you are here. Okay.
Yeah.
Excellent. Okay, have you done it yet?
I'm on it.
You're on it. Okay. That's fine. Elikem. Elikem, does it look like okay, you have by your machine? Yeah. Were you able to do it? Elikem, I can't hear you. Erasmus, Kwanzaa. Okay, were you able to do it?
I'm on it.
Yeah, please, I'm on it too.
Yeah.
Okay.
Yeah.
Gifty. So now, O2.
Hello, sir. Please, I'm here.
Okay. Any
Yes.
feedback? Were you able to do it?
I was having a little challenge with my machine. It was running very slow. I was just able to open it, so I'm starting.
Yeah.
Thank you.
Who haven't I called? Leonie. Were you able to do it?
Yes, sir.
You've done it.
Yes, sir.
Okay. Excellent. Well done. Then who haven't I called today? Rasmus. Lieutenant called. Sadiq spoken a lot today. Chepula spoken. Adam.
Yes, sir.
Okay. How far?
Yes, I'm on it, sir.
You're on it. So the important thing one is to set up the cash flows. Okay, so year 0 minus 50, year 1, then net is minus 51, which is inflow of 2, outflow of minus 53. Okay, year 2, net cash flow is 108 plus 1, which is 112. And then let's do this again. So you go to formulas, financial, IRR. So the number of functions here, NPV, etc., you can do in Excel. Okay, so I've shown you the IRR. Just explore. Okay, these things, well, I teach them. Okay, but I wasn't taught in class. I learned it on my own. Some of the functions, I don't know all the functions. But if I want to do a function, I can understand it. That's what is important. If I want to do a function, all you need to go to the help. Okay, all the functions have a help. where more help on this function. You click on that, they usually will give you an example. Go to the example, you will get it. It's not difficult, it's not rocket science. Okay.
So please, can you take us through how to adjust the decimal point again?
Yeah, no worries. Give me a moment. Okay, so you can even retrieve stock prices. I'm not sure you knew that. Yeah, but you can retrieve stock prices from. You can use Excel to retrieve stock prices. And these are the data sources. Okay, so just Argentina, Australia, Austria, Belgium. Let me see if Ghana is there. Do you see Ghana? Jane?
There's no way.
So Ghana and come.
We will be coming soon.
Coming soon. Okay, so yeah. So I'll encourage you to just, maybe if you have time to, you can arrange time with the TA if he has time. He can take you through some of the functions, NPV, internal rate of return, time value of money, future value, present value, annuity. All those things you can do in Excel. So here, everything is future value. I did effective fee today, that's the effective interest rate. Okay, duration of a bond, you can use Excel to find it. What else? Internal rate of return, I showed you. Modified duration, you can use Excel. Modified internal rate of return, you can use Excel. NPV, you can use Excel. Treasury bill prices, you can use Excel to find it. Okay, what else? Yeah, you can do future value, present value, annuities. Annuities is your PMT. Okay, so Excel is an interesting tool that is available to you. Efficient, okay. It has its limitations, okay. Next week we'll talk about Python and the price of Python. Python has unlimited space. Excel gives you about 1 million rows. These rows, Excel is limited to about 1.2 million. Python doesn't have a limit. So if you're a bank, a very huge bank, let's say in Nigeria, you have more than 1.2 million clients, you can't use Excel. So you need to transition to a more powerful instrument like Python. You can program in Python. Okay, so basically all you need to do is set up the cash flows. Once you have that, go to formulas, go to financial, then look for IRR, which is internal rate of return. Where's that? It will ask you to select values and just pick your cash flows. And you are done. Easy peasy. Now, someone asked about increasing the decimal places. It's here. You come to home. Okay. Do you see decimal places here? So there's left arrow, right arrow with 0.0000. Okay, that's your decimal places. Can you see it now? Theophilus, you see it? So up here,
yes,
you
yes.
have this. Okay, and this.
I think your machine is not charging.
Yeah, fortunately we are closing soon, so thanks for drawing my attention. Okay, so yeah, this one is you able to do on your own. Okay, so how do you find the discount? Okay, let me teach you MPV. I think it should give us the same thing. So how to use the MPV function in Excel. So you go to formulas. This one I did this manual. You go to formulas, you go to financial, let's choose MPV and NPV. It says rate. Which rate was here? Okay, yeah, but we know the rates now. We found the internal rate of return. And then the values are the cash flows. Okay, there's something we need to do. I'll show you. Easy peasy. We have the present value, which is 50. Okay, and so there's a PV of the inflows. Year 1, year 2. Okay, PV of the inflows. If you take it, that's 50. And if you do inflows minus outflows, 50 minus 50 is what? Is 0. So let me take this function one last time. We go to formulas, financial, look for MPV. We choose MPV to ask you for the rate. We've computed the rate already. So we pick the rate. Then to ask you for the values. You want the PVs of the first 2 cash flows. So you choose that and then you press OK or done, and that gives you the PV. And that is what we want, because you know that if the present value of the inflows is equal to the outflows, the difference is 0. And the rate that gives you that is the internal rate of what? Return. Okay, the rate that gives you an MPV of 0 is the internal rate of return. Okay, so we'll end here for today. I don't know about the slides. I don't know how to do. Maybe quickly you can segregate. I'll send you this. Just pull out the return on equity, risk and return for them. Because my slides are slightly different from that of banks. Okay, so just pull out the return, risk and return for them.
Okay.
That's what they need. Okay, guys, so we'll end here. There's one example you can practice on your own before we meet next week. Okay, so I put it here as, where is it? Okay, this is a practice question for you. So you can try this. Once we've done this example, it's the same thing. Okay, only that I have changed the numbers. Okay, so you can practice this on your own when you get the slides before we meet next week. Okay, so we'll end here. Thank you for your time today.